Welcome to episode number 2 in my series all about covered call ETFs. If you've ever been looking for a way to generate high yield income with your portfolio, this series might be right for you. In this episode, I'm going to be talking about EQCL, the all-in-one covered call ETF that promises diversification, income generation, and simplicity in one fund. And don't forget, I'm actually building a covered call ETF portfolio from scratch, which started in the first episode. Today, we're going to be checking in on that portfolio to see how it's performing, and we're even going to buy a few stocks. So buckle up, no breaks today, folks. Let's explore the covered call ETF, EQCL, and see if it is the ultimate income generator for your portfolio. If you're new here, my name's Darren, and I started this channel to help out beginner investors because guess what, folks? 20 months ago, that was me. And in that time, I've built a portfolio that is worth $320,000. Now, what can you expect in my videos? In the first part of the video, we actually go over my main portfolio, which is me growing my TFSA from zero to maxing it out, the original reason that I started my channel. And then we jump right into the main topic, which today is talking about EQCL. So let's get into it. All right, so the portfolio is sitting at $165,942. The main portfolio consists of 4 separate accounts with a new addition, which is the cash account, the TFSA, My RRSP, and the Kids RESP. And of course, in My RRSP is the new Spousal one that we're using for this covered call series. Now, my cash account is holding $20,000 and it's earning 3.25% interest, and I use Wealthsimple. Now, if you're wondering, I get a lot of questions about this. This is my emergency fund, but why do I have it in cash like that? Because I want it liquid. If I need to access that money, I want to be able to get at it right away and not have to sell some stock positions off that would result in maybe a loss here or there. All right, so my RRSP is sitting at $19,910. Over the last day, it's up $22. Over the last week, it's down $310. Over the last month, it's down $225. Over the last 3 months, up $1,200. Over the last year, it's up $3,618. And all-time returns on the account, $4,198. Now, with this particular account, I don't make any contributions to it right now because we're trying to max that TFSA out. Currently, there's $40.07 sitting in that account, which is a bit unusual if you've been following me for a while. The reason for that is if you watched my monthly update, which was actually the year end, I rebalanced my accounts, which I showed in that video. And now I've gone ahead and I've done the same thing in my RRSP and my TFSA. So now we'll go over the changes that I made in this RRSP account. Here's a quick overview of the different holdings that are within the account presently, and then I'll talk about the changes that I made. All right, so using Passive, which helps me track all of the different accounts in one place, it's a great tool to use, and if you want to get started with it, there is a link in the video description below that can get you started, save you a bit of money if you're not a Questrade user, because if you're with Questrade, it is free. If not, check out the video description below and use my link, help support the channel. So my RRSP is sitting at 96% accuracy with my asset allocation. And as you can see, there's $27 in USD sitting there. And like I said, the account's sitting at roughly $19,000. What Passive does for us is it makes suggestions based on the amount of money. So what it's telling me is with that amount of money in there is I should buy 1 share based on my asset allocation of HYLD. So I go ahead and I'm going to make that purchase. Now, I use Wealthsimple as my main broker because it's the easiest I find for beginners. It's not necessarily the best one out there. If you've been around for a little while, you might find other brokers that work better for you as you become more advanced, but as a beginner, I like this because it's very simple to use. So on here, we have an activity tracker, and this activity tracker lets me go over what's been done. So I usually share that with you guys. So here we go. We've had VU pay out a dividend at $17.33. We also had CNR pay out $5.98, and then Tesla paid out $31.41. But here is where the rebalancing happened. So Tesla was reinvested, the dividend that paid out, but I went ahead and I sold off the entire TSLY position. And I talked about it in my other video at the month end about why I made these decisions. In this case, this is a yield max covered call ETF, which generates monthly income. And for me, I don't think I really need sort of this high yield income right now. Not only that, but the NAV or the price of the stock is affected quite drastically, even though you're getting some monthly generated income. And you can see I only had $387 worth of it in USD. And I feel that before I retire, this money could be used elsewhere. So I sold off that position. And then I took that money and reinvested it back into several things. So in the activity tracker here, we can see that CNR dividend was reinvested. There's HYLDU. So I purchased HYLDU with the funds from the Tesla sale, and I bought 1 share of AVUV. And finally, there is the pending sale that we just talked about of HYLDU from what I just previously showed you. All right, so my TFSA is sitting at $48,011. Over the last day, it is up $35. The markets have been a little volatile lately. So over the last week, it's down $957. No need to panic. And over the last month, it's down $922. Over the last 3 months, though, it's up $1,225. Over the last year, it's up $5,834. And finally, all-time returns up $6,807. Right now, there's $9.20 in here to trade with. Again, I did a quick rebalance in here, so that's why there's a little bit of cash, because normally there wouldn't be. Of course, I do have stock lending turned on in my TFSA. I've earned $3.56 by loaning stocks out. Currently, the next payout will be January the 15th. We have CNR, Plaza REIT, and REI that are loaned out. And of course, once they're loaned out and they come back, I get a small return on that money that I then reinvest. All right, we're gonna go into what I did in the account to rebalance it. And you can see here on the screen that at the top, the very first holding I have is BAM, or Brookfield Asset Management. It is one of my strongest single stock positions. And as you know, I don't hold very many of them because I'm more moving towards ETFs. And of course, I have a small portion of my account in single stocks. And if you watched my year-end video, you'll hear me say that over the next year, I'd like to learn a lot more about perhaps picking some single stocks as a very small percentage of the portfolio, but that's something that I want to work on over the next year. So looking at this account, of course, what I did is I get a report back from Wealthsimple that tells me how much money I invested. And one of the big things that made me proud this year is that I put in just under $25,000 into my TFSA this year. And again, for many people, that could be very overwhelming. So start small. For me, I got to make a lot of time up because of my age. So I was just shy of $25,000. So I made a deposit there, as you can see, of $50 just to get it over that $25,000 mark. And we can see here that CNR paid out a dividend of $3.39. And then, of course, because some of the stocks were loaned out, I got a manufacturer dividend of $1.69. And of course, those were then reinvested back into CNR, which you'll see in the activity tracker here in a bit. The other thing that I did was that I sold off some shares of Brookfield Asset Management. Now, you've heard me talk about this before, but Passive, the tool that I use, actually makes recommendations to buy stocks, but it also makes recommendations to sell positions to rebalance your portfolio. Now, I did use this tool to get an idea of what I should buy or sell, and from the recommendations that Passive made, I made the decision to sell simply Brookfield Asset Management. As you could see in the first part of this video on my TFSA, it was up near 70%. So I'm selling some of it off in order to capitalize on some of those gains and then reinvesting it back into some other ETFs. So we can see here, there's the CNR reinvestment. And then with the money, which was about $1,000, I used Passive then to use my asset allocation and figure out what I wanted to buy from that. All right, and so when you watch this go by, you're going to see the various funds that I had that money put in. In simplicity, I basically put them into basically what you see me do every 2 weeks into those ETFs, because it was about the same amount that I do, which is about $1,000 every 2 weeks. Okay, let's jump into Passive now. We're going to look at the performance. So net contributions is $2,148. This is just in the month of December. Of course, we've been making contributions every single month. The net change in the account, $1,286. The rate of returns down minus 0.2%, pardon me. Again, the markets have been a little volatile here towards the end of the year. No biggie, I'm not concerned about it. Investment growth is down $861 in the month of December. The average monthly dividends worked out to $40 in this month, but of course, as the account grows, we're going to see more dividends coming into the account. We don't pay any fees and commissions because we use Wealthsimple. If you want to get started with Wealthsimple, check out the video description below for my link to help support the channel. And of course, the total dividends just in the month of December, like I said, were $40. All right, all-time returns on this account since its inception in April of 2023, $46,960 are the net deposits into the account. We've been contributing for every single month. The net change in the account, $48,012. And the rate of return on this account right now is 18.39%. And of course, our average dividends every month are $50 for the entire portfolio of all-time returns. Total commissions and fees, zero because of Wealthsimple. And lastly, the total dividend income for this portfolio is $1,050. Now we're going to deposit that $1,000 into the account. We'll use passive and we'll go over those recommendations and make those purchases. All right, so the $1,000 is now deposited into the account. And if you noticed in the deposit, I actually added $2 more. I want to slowly start increasing that amount that I'm depositing. The account is 96% accuracy with my asset allocation, with a total of $1,011 in there to trade with. So the first thing we're going to buy is 2 shares of QQC, 1 share of REI, 3 shares of VFV, 2 shares of VRE, 3 shares of XEC, 4 shares of XEF, 3 shares of XEI, and 2 shares of XIC. Okay, so the plan with this account was to invest $5 a day. I'm trying to make this simple so that I can show other people you don't need a lot of money to basically get started, even if it wasn't a covered call ETF portfolio. So $5 a day. And of course, the other thing that I'm doing is, if you watch my series, I'm making interest on that cash account, and that is taxable. So normally what I do is I take that and I put it into the Spousal RRSP, which is with Questrade. But because we're starting this, I'm actually going to be depositing that money into this account as well to help it grow a little bit faster. And of course, as time goes on, I'm going to increase the amount, making it simple, not large amounts. And if I happen to come across a little bit extra money, we'll throw that in there as well. Small amounts can help a portfolio grow quite quickly. So you can see here that last month, the interest on the cash account was $60.60. So what we did is I took that money, deposited back into the Spousal RRSP, and now we're going to actually reinvest that money into the various holdings. Now, the other thing is when I transfer money into this account, there is a 3-day wait or hold from the time that the money is deposited in order for me to be able to use it. So as the money becomes available, I then look at it, we'll make investments, and then every about 4 weeks, so once a month, you're going to see one of these updates where we'll talk about covered calls and see how this portfolio is doing. So here we go, moving that money over into the Spousal RRSP. Okay, so the account's holding $825.28. Over the last day, it's down $9. Over the last week, it is down $21. And over the last month, this account is down $18. And that's about how long we've been using it, so the all-time returns don't really mean much. There's $10.05 available to trade and $6 that's not available to trade because it's still waiting to be transferred into the account. We currently have 16 shares of EQCL and 27 shares of HYLD, and you can see that both of them are down slightly. And I'll jump over and I'll show you what it looks like in my spreadsheet so we can see what the estimated income will be on this account. All right, so I created this spreadsheet and it tracks all the different portfolios I have, and you can see here that I have this Spousal one set up now, and it calculates based on the dividend how much we would reasonably be getting both on a monthly basis and over the year. So right now, HYLD is going to pay out $3.61, and EQCL will pay out $3.92. And over the course of the month, that totals about $10.85. And of course, the more we add, the higher that becomes. And of course, it shows the annual income sitting around $43 for EQCL, or pardon me, HYLD, and for EQCL would be about $47. So again, we're going to monitor this and see each month how much we're generating in income and how quickly we can grow this account. All right, now I told you that I was taking that interest money and depositing it in. When you transfer from Wealthsimple within, so that's where the money came from, it's instantly available. So we can see here I actually have $70.65 to trade with. So we'll jump over to passive. Passive will tell us what to buy. Now in this case, it's a 50-50 ratio, 50% HYLD, 50% EQCL. And so it's going to be pretty simplistic. It's just going to split it down the middle, but here we go. So the accuracy on the account through passive, 91%. There's our $70 to invest with a total of $819 in the account. And there you go. You can see it's telling us to buy 2 shares of EQCL and 1 share of HYLD. So we'll go ahead and do that, and then we'll start talking about EQCL. All right, now let's talk about the EQCL all-in-one covered call ETF. This is a Global X product. And the best place to start looking at information is to go to their website, and you can read all about it through their fact sheet or just through the website. And you can actually download PDFs of the same type of information. All right, so the current stock price, according to their website, is $22.73 with an annualized distribution of 11.04%, which you saw on the thumbnail when you clicked on this video. As far as risk goes, they rate it as a medium risk. Of course, that's interpreted by the user. It could be high risk because some would say that covered calls are definitely higher risk than, say, holding some other equity. That's ultimately up to you to decide what your risk tolerance is. So they say that this particular ETF is to unlock the growth potential of an all-equity portfolio using light leverage. Leverage in an exchange-traded fund is a way for the fund managers to create larger returns by writing call options on the underlying holdings. All right, so this trades under the ticker EQCL on the Toronto Stock Exchange. The fund was started in October of 2023, so it's not very old, and it has about $25 million in assets. Now, if we take a look here, this is one of the most important things to look at when it comes to purchasing various stocks or ETFs is how much is it going to cost you, because the fees are equally important. So it says that the management fee here is 0.75%, but what it says underneath that is that the management expense ratio is actually 2.26%. So the most important takeaway here is that the MER is the one that you want to pay particular attention to, not just the management fee, because the MER encompasses the total amount of fees that they're going to take in order to operate this fund and pay the people that are doing it, because they're, as you'll see in their holdings, they're not just dealing with one particular holding. So what does that mean in the grand scheme of things of money when it comes to that type of MER? Well, let's assume you had $10,000 invested in a fund with an MER of 1%. You're paying $100 over the year in order to hold that particular ETF. Now, in this case, it's over 2%. So you're talking about $200. So something to keep in mind, if that MER is high, you might be chipping away at some of the returns that you are interested in. Now, maybe if you're older and retired, that's not a big thing, but if you're younger, this is probably something that you may not be interested in unless you're willing to give up that amount of money. Now, this is the part that makes this particular fund rather interesting, is its exposure. So there are a number of holdings within this. That's why it's an all-in-one. So by paying, say, $100 buying shares, your money is then distributed and you don't have to do that. So here are the different funds that money is invested in. Now, these are all Global X funds. So basically, you put your money into EQCL, and then they take your money and put it into these other funds. That's the Global S&P 500 Covered Call ETF, the Global S&P 60 Covered Call ETF, the NASDAQ 100 Covered Call ETF, the Emerging Markets Covered Call, and the MSCI Covered Call, and lastly, the Russell 2000 Covered Call. So you're definitely getting a lot of exposure. We're talking about Canada, the United States, and then all around the world. So if it's exposure that you're looking for when you're trying to generate high yield income, then this is the fund that is likely going to work for you. Now, I did some research, and it doesn't look like there are any other funds that are the same as this particular fund as a covered call. The ones that would be similar that are not covered calls that I hold would be XEQT. All right, so I always like to use Google in order to tell me about the performance of a fund. Again, as a beginner, it's easy and it's free for me to access. So here is Google, and of course it shows that this fund has had a steady increase. So we're not seeing red, which is a good thing. So a slight steady increase, which is what they said in about their fund, is they want to see some stock appreciation as well as that 11% yield annualized that comes back on a monthly basis for you. Now, if we jump over and we compare that to other funds, so I told you that XEQT is one that I hold. All right, so here's a comparison of EQCL against XEQT, which is one of the other funds that I hold as well. So the red line represents XEQT, while EQCL represents the blue line. And we can see that there is an underperformance when it comes to this particular fund against another fund that's similar that doesn't write covered calls. Now, a lot of people would argue that it's total returns, and that's why we're running this experiment to see what those total returns look like if we reinvest the dividends. Now, a lot of people that want to use covered calls are looking down the road and saying that I want to be able to take some of the income that's generated on a monthly basis and take it out of the fund. So then one has to wonder, if you're taking money out of the fund, would you actually get the total returns that they talk about? That we're not sure about, and I guess we'll see as we roll into this experiment. So if we jump over one more page, I compared it against another fund, which is HYLD, which is the other covered call that I hold. So HYLD is the red line, and the blue line is EQCL. And of course, HYLD and EQCL have been around, I would say, a similar amount of time. And we can see that HYLD is actually outperforming EQCL. Now, HYLD also is an all-in-one investing in other assets. So if you watch the first video in this series, you'll see me talk about what those are. But as we can see, it's actually outperforming EQCL. But we are diversified between the two funds because it's all in one in both cases, covering different areas. So EQCL will be around the world, and as you can see by HYLD, if you watched that other video, it's elsewhere. So I wanted to show you a comparison of an MER for a non-covered call fund. In this case, it's XEQT, which I hold. And we can see here that the fund actually has an MER of 0.20%. So significantly different as far as the amount of money that you'll be paying to hold this fund. Now the difference here is that this fund only pays out a quarterly dividend, and the dividend is obviously not anywhere near as high. So if you're looking for monthly generated income, definitely this fund won't work for you. And of course, EQCL might, and that they're very similar because they invest around the world. All right, so one of the other ones that was on the list was the TSX 60 covered call ETF, which in this case is now CNCC. One thing that I didn't notice in the list of holdings is the actual tickers. I'm not sure why. Typically they would list them. I did a bit of searching on their website and was able to find this one. So again, you buy a share of EQCL and they turn around and invest a percentage of that into CNCC, which is the TSX 60 covered call ETF. But when we look at the holdings on this particular fund, while it is diversified in Canada, we can actually see that you're not investing into anything specific. They're actually writing cover calls on another one of their ETFs, which is the S&P TSX 60. So many layers are built into this fund because it's an all-in-one. It's not simplistic of just holding one particular fund, which then invests in a singular position. All right, so the purpose of this video was to show you what's contained within the portfolio and how it's performing. Now, I chose EQCL for this particular portfolio because it is diversified, and the portfolio doesn't really hold a lot of money, and I don't want to have to buy a bunch of different positions right now. Plus, I need to figure out which positions to add to this portfolio, so EQCL fits in there fairly well. Is it the best performing covered call? No, I don't think so, but again, that's the whole purpose of this exercise, is to see where things can go. Now, if you're just starting out with investing, it's always a good idea to have Canadian and US funds within your portfolio. And if you don't know how to convert your money, I've created 2 videos in order to show you how to do that will help you save on fees.